Welcome everyone to 360 Financial's Outlook for 2026. We exist to enrich lives, and we do this by helping our clients plan for impactful financial events. And this includes retirement planning, tax planning, estate planning, risk management, and most relevant for our conversation today, investment management. My name is Michael Urch. I'm a senior wealth manager here at 360 Financial and a certified financial planner. And we have an investment committee here as a firm, and I am pleased to introduce to you a couple of other members of our investment committee. We're joined by Mike Rogers. He's the president and founder of 360 Financial. And over 30 years ago, Mike decided to strike out on his own and start an independent investment advisory firm, for which we are grateful. And then also I have Brian Bonzak. He's the senior vice president of 360 Financial and managing principal of our Elk River office. And he specializes on our investment committee in the fixed income and bond portions of research. So excited to have him join us today as well. And so Mike, Brian, feel free to say hello.
Hello, everybody. Yep. Welcome. Glad you're here. And we're going to have a full hour of really good information for you.
Now, before we get started, we're going to begin with a poll. And so our first question, and you should see a poll pop up. And actually, while you're answering that as well, how do you feel about the economy going into 2026? I'll also mention that at the bottom menu on your screens, you should see a Q&A spot that you can click. We'd like to make this interactive as we go throughout. And so feel free to pop in questions down there. We will have a Q&A time at the end as well, but if relevant questions are being asked for where we are in the presentation, we'll try to address those as they come up as well. With that being said, we have the poll results coming in here. We'll give 10 more seconds to throw an answer in before we end this poll.
Yeah, you remember last year what this poll said, Michael?
I don't. That's a good question. Brian, do you happen to remember?
Well, last year, yeah, about 44% was kind of neutral, and about 33% said it was okay, but some concerns, right, Mike? Is that what the numbers were?
Yeah, yeah, just about 40% on the neutral and 40% roughly on somewhat optimistic. So I think we're seeing a little bit of divergence away from that on the poll. Not by much. Somewhat optimistic is still the leader, which I think was the case last year as well.
It looks like if we combine very optimistic with somewhat optimistic, we're close to 60%, 59% optimistic.
Mm-hmm. Good. That helps.
I'll hand it off to you, Mike, to talk through the economy.
All right. Well, thank you very much, Michael. Thank you, everybody, for being here. Got a lot, as I said, I got a lot for us to cover. Going to try to make this as efficient as possible. We're also going to try to make it a conversation, and at least a conversation between Michael, Brian, and myself. That you might also be hearing, if you will, kind of the same conversation in our investment committee meetings. We do our investment committee meetings every other week. That's where we track all the investments inside of our portfolios. We decide if we want to make changes, additions, or subtractions at that time as well. And today, we kind of summarize some of this information in this presentation. We did get the help of LPL Financial, who is our custodian and helps us and holds our accounts. So most of you know them because you see them on confirmations and those sort of things. So let's jump into what's the economy probably going to be doing, at least what we think it's going to be doing. You know, the story here is the more things change, the more they stay the same. You know, we predicted last year we'd have growth in the economy and we weren't going to have a recession. Ditto. You know, it's just the same thing. So we think the U.S. economy might be a little sluggish here in the first half of the year, kind of because of just a few issues going on. We'll go through those a little bit. You know, being the job market is slowing a little, it's a little sluggish. Wage growth is definitely slower than it was coming out of, the years after COVID when wage growth really expanded. And this nagging inflation, especially around some food prices, will probably dampen growth in the first half of the year. But no recession. We're not looking for a recession. We don't think the economy is going to shrink here in the U.S. in this coming year. We've been saying that for a number of years. And generally, while a lot of people have been pounding the table that we're going into a recession, we just haven't bought into that. And we don't think that's going to be the case this year. So second half of the year, maybe growth picks up a little bit, and then we average out at the year in the 2.2 range, maybe 2.1% growth rate, which is, higher than what we had in 2025, but not as fast as what we had in 2024. So just a basic 2% decent GDP growth rate, with nothing too exciting is kind of what we're seeing for this coming year. So that's really important to know because it sets kind of the table for what else is going to occur, and so one thing that we've definitely seen here that's occurring in a wide scale is technology spending. And there's no doubt fiscal spending is strong at the business level. They're putting a lot of money into artificial intelligence. We'll talk a little bit about the hyperscalers in a minute. Infrastructure is being built out both at the technology level and frankly, just at the bridges, roads, and other construction areas that we've seen. And that's been a good area for us over the years. And we expect that this spending is going to continue. And as it continues, it does support the economy and provide some growth to the economy. So this slide down here, this little yellow section of the pie is really this technology or intellectual property spending that we're seeing. And there's no doubt huge demands for cutting edge technology. And what does cutting edge technology mean? Well, first of all, it means data centers. We're seeing the huge growth of the build out of data centers. It also means huge growth in advancements in semiconductors, AI-driven software. All of these things combined are fueling really big, what's called CapEx, capital expenditure spending by big companies across various sectors. And let's not forget about the energy. Energy is another area that is growing because these new technologies need a lot of electricity to run them. So we think this is going to be a pillar of growth for this coming year, and could be for a number of years, but at least for now, what we're doing is our 2026 outlook, and we see that as a real positive.
The other thing, Mike, on this graph, and I talk to my clients all the time, consumers are still driving the economy. You can see the top two, percentages. There's still a majority, 69% of the economy is driven by the consumer. So if the consumer stays healthy, means keeping their jobs and they still have paychecks, the economy can still keep rolling forward, into 2026 and beyond.
Mm-hmm.
So.
Yeah, absolutely. And that kind of ties in a little bit to the last chart with, maybe sluggish growth in the economy the first couple of months or first couple of quarters of this year as the consumer gets used to, maybe their pay raises aren't as high and those sort of things. Yep.
Definitely. Yeah. The consumers are facing some headwinds. You're right. Their wage growth is not keeping up with their grocery bill and what they're seeing and stuff like that. So is that if consumer inflation can come down, their paychecks will go farther and they'll be able to spend on other stuff, so. And
Absolutely.
and backing up what you mentioned with the business spending, a lot of CapEx ramping up for the AI build out.
Mm-hmm. Yeah. So in the past, we haven't as much CapEx spending. We've been more reliant on the consumer. Now we're saying that there's probably going to be more CapEx business spending because of technology, and that should enhance what the consumer is able to do. Even if the consumer pulls back a little bit, it should be able to enhance or at least
replace
cover it.
Yep.
Replace it. Yep. And that kind of leads to this inflation aspect that you just mentioned too, Brian, is, inflation is is settling in. We're settling in between 2 and 3%. We're probably about 2.5% as far as going forward inflation. Now, this is measured by CPI, and you could argue whether it's a good measurement or not, but it's the same one we've used for decades. And of course, back in 2022, when inflation ramped up out of all the money that was available in the system and all the demand for goods and services that was available in the system, you saw this huge run up in inflation. But it has reduced significantly over the last couple of years. The Fed says they would like to have a target rate around 2. Despite that, they did lower interest rates a number of times in 2025. How many times, Brian? 4, 5?
Yeah.
Yep. So, and Brian, we'll talk a little bit about what we're expecting for interest rates this coming year. The blue line here is interesting. It's an index. It's called the ISM Services Index, and really all it is over on the left-hand side of this chart are some other numbers, and it says anytime that this blue line is above 50, which is most of the time, service companies are expecting that they're going to be raising their prices, or they're seeing an increase in the prices that they're paying. And so you can see a little bit of divergence here, that the blue line has pulled up, and actual CPI is lagged behind. It's not completely unusual. It happened back in 2010. And it happened again in about 2018. But it brings, if the service industry is saying that, the service companies are saying that they're seeing higher prices, when does that show up in inflation? And typically they run together. And we think in the near term, investors will have to bear the burden of some inflation. We especially see it in food prices. Then that's again why we might see second half of the year better CPI growth than first half of the year. So the other thing I'm going to have Brian address is just the 10-year government bond, 10-year treasury, and how that correlates to mortgages, which is a big driver of housing.
Yeah, so the 10-year treasury is right around 4.27 today. You can kind of see it has come down. The forecast is, probably stuck in that 4% range. There's nobody really calling out for a large decrease on the 10-year treasury, which again makes the sense that the mortgages are not going to fall maybe as fast as some homeowners and new buyers would like to see. We're still at that 6.1% range on the 30-year mortgages. I know a lot of people are thinking, hey, if we can get into the 5s, that would definitely help the housing market, which drives a lot of part of our economy. So we'll definitely be keeping an eye on that, and saying, hey, if we start seeing the treasuries drop maybe in the 3s, then maybe the mortgage rates would get into the 5s, maybe later this part of the year. But we'll see. Not a lot of confidence yet, but that's what they're talking about.
Or even, if you saw if you saw 10-year treasuries go down to 3, which would be a pretty significant drop. And I don't know if that, unless the economy really slows down. Sometimes you have to be careful what you wish for, right? So if the economy really slows down and the Fed has to aggressively push down interest rates. Now, remember, they only push down those short-term rates. If the long-term rates follow, like the 10-year, then you would probably see mortgage rates really slide, wouldn't you?
Yeah.
But for the most part, maybe 5% mortgage rates. This shows something that's around 4%, but that's probably a little bit on the optimistic side.
Yeah.
But they're correlated. That's what the chart is.
Yeah, that's exactly.
The other area about growth that we like to measure is what's going on internationally. And we've talked about this a little bit. Last year, we added more to international investments than we have in years. We ran actually zero international exposure for a number of years in our portfolios, and we're running about 10% now. And there's a couple of reasons. We were seeing some good momentum in the international stocks. The values were cheaper. It was a cheaper investment area to go into, and international did really well in 2025. And going forward, what we're trying to capture is, how are the international markets going to do kind of compared to the U.S. when it just comes to simple growth, so GDP growth. And if we're right about the economy here growing at about 2% this year and probably next year, how does that compare to other areas? So the Eurozone, as an example, probably has about half the growth rate. And part of it is they have a high relative energy cost. And you couple that with some issues that they have around their structural weaknesses and productivity and technology capacity. This just limits the Eurozone's international competitiveness and contains their growth, kind of makes them less able to grow. So higher energy prices and not as much built around technology and international and infrastructure like we have in the US. Plus, Brian, I know we track the interest rates of the US in all of our investment committee meetings, but we're also seeing some tightening by these countries and maybe even increasing some of their interest rates.
Exactly. Yep. We're seeing that right now in Japan a little bit.
Yep. And Japan had a huge jump up in interest rates. Yeah. So Japan's goal for kind of this, what they call virtuous cycle, where they get sustainable inflation driven by some robust growth, at least here in the near term, isn't panning out the way that they had hoped for. Instead, they got a huge bump up in interest rates recently, which is, again, not good for your growth rates. So when you look at kind of, where's there some growth internationally, it's the emerging markets and it's probably the Asian markets outside of Japan. That's where most of that would come from. And so as those economies are growing at faster clips, it might make sense for us to have some money allocated towards those. But for now, we're not seeing any reason to really exponentially increase our international exposure kind of across the globe. And remember, emerging market stocks typically have more volatility, more risk. They do trade at lower valuations, but you also get higher standard deviations that go along with it.
Yes.
So anything I might have missed there, Brian or Michael?
No.
Okay. So Michael, how about poll number 2?
For poll number 2, if everyone could take out your crystal balls for us. And what are your expectations for the market in 2026? What are your expectations for the stock market in 2026?
I don't want to sway anybody's votes, but it was interesting last year. 64% of the respondents said that there would be some downturns, but it would recover. And boy, did we have that in April.
Yeah, spot on.
And then a V shape out of that recovery. So we have some smart people on this call.
We'll give it another few seconds here if anyone can get their final vote in before I close the poll. All right, I'll go ahead and share these results. This lines up with what we saw earlier regarding optimism for the economy. So we've got 39% think stocks prices will go up, 33% expects little change, some downturns of that 22, and then 6% expects significant declines.
So especially that 6% group, they make sure you stay in touch with your advisor, going through kind of, we're going to talk about what's going on here, at least what we think is going to be coming up this year. And so these polls are really helpful, for us to kind of gauge where the mindset is for our clients. Now it's a smaller sample. We have about 1,000 clients, and they'll talk a little bit more about our process and our LifeWell system at the end here for you who are new to us and are not current clients. But this is interesting poll because it's a lot more spread out between the answers than what we had last year. So we'll see how that plays out. So let's go into stocks and what are some of the tailwinds to the stock market and what frankly are some of the headwinds. So we'll first, let's paint the picture of what looks good. And these are the tailwinds to the stock market. One of the things that it's very interesting is we're in the 4th year now of a bull market. Bull market started here over in the current bull market in October. of 22. That's after, remember, we had a very rough October. Interest rates went up a number of times. Inflation was very high. The stock market went down. Frankly, there wasn't a lot of places to hide. And what I mean by that is bonds were going down in prices, interest rates were going up, the stock market was going down. So you just had to kind of get through it. And if you did, you were rewarded with some pretty really healthy returns over the last few years. So we're in the fourth year of a bull market. What typically happens in the fourth year of a bull market? Well, if history is any guide, then again, there's no guarantees that the past is going to get repeated again in the future. But if the history is any guide, this bull market might have some more room to run. The S&P 500 has averaged 12.8% gains historically during the fourth year of a bull market since 1950. So, we're going back 7 decades basically. And out of that time period, when this has occurred, when we've had 4 years of a bull market run, this fourth year has been positive 6 of 7 times. So the odds are pretty good looking at this historical data that this fourth year should be a good outcome. So the one thing I will mention, the S&P 500 at the beginning of this year was priced at 6,858. If it grew by 12% this year, that would put the S&P at 7,680. And if the S&P's growth rates, FactSet that follows what's predicted for growth rates in the S&P 500, if that comes in at $320 for the S&P 500, that puts us at about a 24 price to earnings ratio if you would get that sort of growth rate, 12% growth rate. So it seems high. Potentially, we'll talk about midterm election issues coming up next, but that means that the market, frankly, is not cheap. It's been more expensive in the past, but it's pretty clearly expensive at 24 times earnings. If you could get a 12% growth rate, right now it's trading about 21 times earnings, future earnings, if you just look at the 320 number as far as the growth. So my point is, I'm going down a little bit of a rabbit hole. Fourth year of a bull market tends to be very strong. Okay. What also helps the stock market? Interest rate cuts. We've just seen a number of interest rates cuts in 2025. Typically, the S&P 500, again, we'll use that as the proxy. Remember, there's small caps, there's mid-size stocks, there's international stocks, but we use the S&P 500 as a basket of 500 stocks as our proxy. And
I think well, I was just going to say, I think this chart's really interesting because what we're looking at is 28 times in the past after the Fed cut rates, what did the S&P 500 performance do? And that's this blue line here. It averaged that 13%.
Yep.
But what if we include an overlay of with no recession or with a recession? And so if there's no recession happening in that 12-month period, it's averaging 18.2. Now, if a recession does come into play, it's averaging negative 2.7. And so when you kind of take this into account with just thoughts Mike shared earlier on, we're not seeing a recession. We're seeing that, as you likely know, a recession would be 2 quarters of negative growth in GDP. We're expecting good growth for the GDP throughout the course of the year, especially in the last half. And so if we're able to do this rate cut cycle and avoid a recession, historically that's looked good for the S&P 500 outlook.
Yeah, great way to explain the charts. We weren't in a recession when they started cutting interest rates. A lot of times we're in a recession, and that's why there's think of 2008, right? 2008, 2009, Fed had to aggressively cut interest rates because of the Great Recession. In this case, when they started cutting rates, we weren't in a recession. So to Michael's point, when you're cutting rates in a growth economy, that's typically bodes very well for the S&P 500 returns in the future. Again, frankly, it's gone up every time in 21 instances where this has occurred. So again, history is no guarantee of what's going to happen in the future, but it does gives us some things to reflect upon, and to study. And this is the other thing that we can study. There's a lot of money being spent on AI and technology. And so what this chart is just illustrating is the quote unquote hyperscalers are spending a massive amount of money. Approximately $520 billion is being spent on AI technology. So this bodes really well for the economy, like we talked about earlier, and it bodes really well for companies where these hyperscalers are buying goods and services from. So software companies, technology companies. What's interesting, if you look at this 40% compounded annual growth rate, a lot of these stocks up here, the hyperscaler stocks, except for Google, Alphabet, haven't done that well. And it's a little bit of a, if you think about it, it's a little bit logical. The reason they haven't done that well is because people are worried that they're spending $500 billion on AI technology.
Right. And there's not going to be a return on their investment. So the shareholders are kind of saying, hey, I'm not going to pay up for Meta stock or, Microsoft stock until they prove to themselves they can generate revenue and bring that money to the profit, down to earnings, because we know price of stock is driven by earnings. So yeah, it's kind of a wait and see thing, Mike, about some of these companies. So obviously these guys are being run by very smart people, good board of directors. So obviously they're not going to spend this kind of money if they don't think somewhere down the road near term that there's going to be profitability for all this money that they're spending today. But it's a kind of a wait and see, right? So
yeah. And so when you look at that, like Google, I mean, you bring up a great point, Brian, because Google has really done a good job developing their own AI Gemini program. It competes with ChatGPT. Latest reports is the most recent version of Gemini is leapfrogged over the ChatGPT abilities and is kind of now the leader in this area. And their stock has done really quite well. So out of all of these, their stock's done the best.
Yep.
So the one thing that's also interesting is we recently, within our investment committee meeting this week, we looked at one of the holdings that we have that's investing into internet stocks. So it does own Meta, it owns Amazon, owns Microsoft, and we decided to remove it from the portfolio because the momentum had just kind of gone away. It wasn't moving up any longer. And that's part of what we're trying to track within our models and our portfolios on certain areas of the market, certain areas of the portfolio, that momentum, and so we're taking that money and we're going to move it to aerospace and defense, that has a little bit more positive momentum to it. But these companies are spending money and it's going to impact the economy in a very, very positive way.
And there's also just other ways to maybe benefit from investing in the fact that they're doing this investment in all the data centers. It needs to be powered by enough electricity. And so we have exposures to some nuclear energy companies because we think there's an opportunity there. And also just broader infrastructure needs to be built out to allow these data centers to be on board. And we have an investment in infrastructure that we've had for a number of years. And so this is a trend that we've really talked about quite a few times through the course of the last 18 months or so in our investment committee.
Yeah. The other part too about the artificial intelligence, some sectors that have not been really, interested or using AI will benefit from their investment in AI. And one thing we've been talking about in our investment community is the biotech. Drug manufacturers can get drugs out faster because of the AI technology. What used to take, a pipeline to get a drug through a pipeline was extended amount of time. They can shrink that time and get that drug out quicker. Obviously, more sales, more profitability. And so sectors like a biotech could really benefit from some of this AI infrastructure that being spent. So, and we have that now also in our portfolio.
Yeah, the biotech area, the infrastructure area, aerospace and defense, they can all benefit from better technology. It's a good lead into this. A lot of people have talked about the Magnificent Seven. to a lot of the stocks that we just, have discussed, and rightfully so. This chart here is showing earnings of the S&P 500 and earnings of the Magnificent Seven stocks. And the blue bar is the representation of those Magnificent Seven stocks. And the reason they were driving the returns in the S&P 500 is because they were driving the earnings. And to Brian's point, stocks usually follow earnings. Okay. But it looks like, at least if you go over here to the right on the forecasting, the Magnificent Seven stocks will have less earnings growth compared to the rest of the market. And that might also bode well to companies that their stock prices haven't done that much. I mean, good example, at one of our investment committee meetings, we were looking at the S&P 500 rate of returns in 2025 were about 17% for the S&P 500, give or take. Okay. The S&P 500 equal weight. So you take all 500 stocks and you put the same exact amount of money into it versus market cap weight, which means the bigger companies in the index get the most amount of money of that dollar you invest. So spread it out versus weight it towards the big companies. You know what ended up happening? That spread out between the equal weights, that index was about flat. About flat shows you so much was coming from those bigger companies. So we might see, with that in mind, and if earnings start normalizing across some of these companies, when we get earnings growth, maybe we'll get a broader based participation of stock prices in the S&P 500 than we did this past year.
Right. And that's what the graph is showing with the brown or orange bar, how it's going from Q4 25 all the way up to Q of 26. You can see how it's growing of the other 493 companies,
Yep.
So,
But it's still to the point, we still like the technology area and large cap growth stocks because look at, how well they're still above
they're still growing.
the rest of them are. Yeah. They're just not growing as fast. Yep.
As there used to be. Yeah. But still pretty good growth. I mean, so 20+%. So.
Yeah. So we think, so again, you look at, there's a lot of positives for the stock market. Here comes, where's the headwind? It's these midterm elections. Okay. So when we have midterm elections, that traditionally is not very good for the stock market. Okay. So here's where we're at currently, just bring us up to speed. And I had to look up these numbers, make sure I had them right. The Republican majority in the House is razor thin. We know that. They hold 219 seats, one more than the 218 needed to have a majority. So you can't get any closer than that. Okay. This represents the slimmest margin since 1930, and for either party, and significantly increases the risk of a shift in power next fall. And what I mean by the risk is that creates some uncertainty. The markets aren't going to know what's coming. And when we get political uncertainty, that usually shows up in volatility within the stock market. Okay. So in 20 of the last 23 midterm elections, the sitting president's party has lost seats in the House. And we see this year after year, or midterm after midterm, right? And the average decline of those seats are 27 seats. So if that would play out again this year, that would say the House would flip. Then it would go to Democrat control versus Republican control. We're not making that prediction at today's Outlook webinar. What we're just saying is it seems likely that could occur. And that just creates more midterm elections, create more volatility in the stock market.
Right. And that's kind of represented by that brown bar on the midterm, the drawdown. That's yes. The inner year volatility in the midterm election year is typically the largest or more volatile year of the four in any presidential cycle, as you can kind of see. So, but the overall year, the blue bar represents a positive. So, we may experience, a month or two of some volatility leading into the November elections, but at the end of the year, like I said, the blue bar shows some positive year-over-year results or positivity for the markets.
Yeah. And this number, because it's kind of hard to read on a bar chart like this, but basically what it says is on average during a midterm year, the S&P has averaged about 4.6%. And with this max drawdown just basically mean what time does it go down? Remember, the markets go down every single year, just about, and this is saying that typically when the markets go down, it's about a 17% decrease in the markets. But to Brian's point, by the end of the year, they typically end up about 4% to 5%. So here's our headwinds. We know one thing, what we don't have control over is what's going to happen in the midterm elections and what the results are going to be. What we do have control over, if this sort of thing, concerns you, if you're losing sleep about it, talk to your advisor. We can talk about changing your asset allocation potentially. We've got to make sure that you're comfortable because frankly, we just think there's going to be a lot of volatility in the second half of the year. And if you're not comfortable with it, the last thing that we want you to do is bail out of a strategy that's worked pretty well for us because you get uncomfortable with it. We call it the lifeboat drill. Just get ready for needing the lifeboat. And Dan on our investment committee likes to bring that up a lot as far as a term that we use. And again, if we knew for certain aspects of this were going to happen, then we would know what to do. But the great thing about the investment world is we don't know for certain what's going to happen. What we can do is look at the data and say we could get some real good volatility, not good in a nice way, but a lot of volatility in this coming year. I think that's all I had for that.
Well,
page.
I think go back one, if you go, but then the next year, 2027, this graph says it's going to be a really good year. So again, you want to be, comfortable with your risk tolerance, but we also don't want to lose sight over a 12 or 24 month cycle that the following year of a midterm election is really the best year. That's the blue bar representing on average, the returns are the best out of the 4-year cycle of any presidential election. So, and the drawdowns are less in that third year of a presidential election. So, yeah. So we have to kind of weather the storm maybe here in 2026, but brighter skies are maybe potentially what this graph is showing us is coming brighter skies in 2027. The way, so.
And it gets, absolutely right. Thanks for bringing that up because, it gets again into the long-term perspective of what we're doing, short-term or especially short-term political changes in the market are not things that we can really anticipate, nor should we act on, because they tend to go away. And like Brian said, is once the political aspect gets, and it doesn't matter what side of the aisle you're on, once it's determined who's going to control the House, the following year, the markets just say, okay, we're back to business. And I know we could argue this time is different, and there's all this divide, and but at the end of the day, we still stay out of the politics and we look at the policies and we look at the trends and try to focus on the longer term aspects of the market. But talk to your advisor if that makes you pause or have concerns. So Michael, you're up as far as the bond poll.
That's right. We've got poll number 3, bond market insights. How do you feel about investing in bonds right now? I love that the top option has an exclamation point at the end. That's not something that people often include when talking about bonds.
They don't get that excited about them typically, do they?
We want to be boring in the bond market.
Yep. It's not as much fun to go to a party and talk about your bond portfolio. It is that AI stock or NVIDIA stock that you bought, so there's part of that. Bonds have a place in a lot of portfolios, that's for sure.
They have a place. They tend to be less exciting than stocks.
Yes.
All right, if you haven't replied, we'll be closing the poll shortly. Feel free to finish up with your replies. And I'll go ahead and share those results. We have someone who's excited.
All right. Yep.
No one seems to be worried, though. It seems like the majority think that bonds are okay, but have some reservations.
Interesting. Because last year we had 44% of the group were neutral. So about half now, and so last year, I remember we talked about interest rates coming down. How does it impact bond prices? We thought there was actually some good opportunities in the bond market. And so it looks like, and we did get that, and that also maybe is influencing the poll here that bonds are okay. So let's move into bonds then, based on that poll. And again, Brian, I'm going to have you speak to it since you follow this and at our investment committee level meeting and follow what the Federal Reserve expectations are. Do you want to talk about this chart?
Yep. So again, we talked about this a little bit earlier that the Federal Reserve controls the short end of the interest rate curve, but obviously 10-year treasuries kind of more influence the mortgages or the longer term. But what this graph is saying that if it follows, it trends, it's not a one-to-one relationship. But we know if we start seeing any potential cuts in the Federal Reserve, that the 10-year treasuries and the mortgage rates could come down, and that's what this kind of represents. So on the next slide, we'll kind of talk about, or we'll talk, what do we believe about the Fed and how many more rate cuts we might see. But, we may see some rate cuts in the mid-year, and we'll see what happens in the second half of the year. Like I mentioned earlier, potentially 1 or 2 rate cuts sometime in 2026, and then kind of a wait and see maybe to finish up the year is kind of what the prediction. There's a, what the Fed watch, they call, people watching the Fed, what they're estimating, what they're predicting. So also we have a Fed chair change out. So there'll be a new chairperson named in May. He or she may have a different, influence over the board as well. So we'll see how that plays out as well on some decisions, what the Federal Reserve will do in the second half of 2026.
And isn't that too, when we talk about at the investment committee level meetings, that, if we do see rate cuts, 1 or 2, probably in the second half of the year.
Yeah, starting. Yeah, they meet 10 times a year. So we probably will see some rate cuts after May timeframe, but prior to the end of the midterm, or mid-year, I should say.
So then if we see 1 or 2 rate cuts on the short end of the curve, we probably don't see a dramatic, and we talked about this already a little bit. We don't see a dramatic drop in like the 10-year bond rates, and therefore we don't see a dramatic drop in mortgage rates.
Yeah, I agree. I think it's a 0.5 point, probably is what we're going to see total. So,
Yeah. So with that in mind, this is an interesting chart. If you want to spend a little time, what happens when interest rates do get cut, and we saw this in 2025. This data prove out. So maybe it's something you could go through with our viewers.
Right. So, in the middle column, if there's no rate changes, some bonds are more sensitive to that. If they start cutting rates, on the bull case side, some rates are less sensitive to that. So I think that's kind of interesting. So, like on the bottom, that's emerging market debt. So, debt that's held outside of the United States and emerging countries, if we starting seeing rate cuts, it goes from 5.8 to 8.6, pretty exciting. But if you go up to like, corporates, well, even like, U.S. corporate index, also, if we get some rate cuts, goes from 4.8 to 8%. 8% is almost like equity-like returns, between those two. So, so your poll people that say, hey, they're optimistic about the bond market, they must be also optimistic they're going to see some rate cut changes. So that's kind of interesting to see that. And then in case, I don't believe this is going to happen, but if they start raising rates again, 0.5% or 1% under the bear case, obviously there's some things that would really throw the bond market into a downspin. We would go from again, the corporate index, corporate bonds, could barely break even or even go negative, because that's how sensitive they are to interest rates. And that's what that last column says around break even change. So when would the bond market be a 0 or that index be a 0 if we had a rate change of 0.7 on the corporate index side? Much different than the high yield index down there in the third from the bottom. We would have to have a 2% swing before that index would be a negative or a 0 or a flat. So kind of to show that. So pretty technical stuff, but again, part of our investment committee is that we are exposing our clients to different types of bonds based on what we believe interest rates are doing and, where we can get the best yield with the less volatility. Going back to our comment, or, bonds, we want to be boring. That's their role. But there is some navigation, there's some decision making to be in the right bonds at the right time, depending on the overall interest rate movement.
One of the really positive things for the bond environment right now is just that base case of the intermediate corporate at 4.5%. I mean, if we go back a few years, we would not have been able to get an interest rate of 4.5%. And so from just getting an income from the interest, I mean, that's a really positive place to be for bonds right now.
Yeah, especially as inflation comes down, that difference between inflation and what we can get in safe, corporate bonds or government bonds, you're getting paid very nicely, for a low risk, zero risk, type of investment if it's, government treasuries and stuff like that. So,
Yeah, well, excuse me. And the other thing that happens too, of course, when interest rates go down, you guys just alluded to it, cash rates go down, so the money market rates have dropped. So it was a little over a year ago, maybe 2 at this point, where money markets were around 5% interest. Now they're more like 3. So, if inflation's 2.5 and your money market's paying 3, and you got to pay taxes on your money market, you actually are losing buying power, so there's some advantages to looking at this bond part of the portfolio. And remember, for us, a growth model that we utilize is typically about 20% fixed income. And so that would be in bonds, 80% would be in the stock market. So majority of our clients do own bonds, they're bond ETFs or bond funds. And in this past year, while they weren't as good as the stock market returns, they were very, very solid, pretty much right across the board. More in this bull case type of rate of returns is what we saw with our bonds and the models. The only exception, which was a hugely positive exception, was something that doesn't show up on this as an index, but it's convertible bonds. And so it's a little bit of a hybrid type of investment. It's a bond that can convert to stock at some point, and hence the name convertibles. So there's more correlation to the stock market. And so as rates were coming down and the stock market was going up, you saw returns in this convertible area that were 20% plus, because of both factors working in its favor. Probably not likely to happen again, but the bond part of our accounts, whether you're 20% bonds or 40 or 60, did really quite well last year because of the declining interest rate market. So good year for bonds. We think going forward, we'll probably have base case or maybe a little bit better, depending on what happens second half of the year with interest rates. So we have, excuse me, I jumped right past it. Poll number 4.
Our question here is, which investment strategy do you find most appealing for 2025? We've got a few different options there.
I was going to say there for a second, I didn't see anybody answering. So I was like, oh, did we lose our audience?
Which investment strategy do you find most appealing for 2025? Waiting for a few more answers to trickle in. I'll give it about 10 more seconds here. All right, here we go. I'll end the poll and share results. Looks like 81% like stocks and equities for growth, and 19% are feeling more cautious.
That doesn't surprise me based on the headwinds and tailwinds that we just discussed. It's but the 81% on the focusing on stocks and equities for growth, long-term investors best been served when you own companies. And so more volatility. So it's good to see it. I'm guessing that's just our messaging has been for decades. Let's focus long term. Let's buy good quality investments and ride through the waves. It sounds like the panel of respondents is kind of on that track. So that's great. Last year that was only 55%. So that's interesting that we've seen a nice pickup to 81%.
Mhm.
So, all right, with that in mind, there was a question about alternative investments. We really don't know if alts make sense in most people's portfolios, specifically private equity, private credit, private real estate deals, those sort of things. What we do know is when you look at kind of what's going on in the marketplace, there's a boom kind of in merger and acquisition deals. And when you look at the value of the deals, they're increasing over here. They bottomed out in 2022, which is no surprise. When rates go up, values of deals go down. The number of deals globally dropped, but it's been picking up, and it looks like that's going to continue. And that will benefit us not only on private equity, which again isn't part of our strategy, but in the public equity markets, specifically areas maybe like the biotech that we brought up earlier. There's more mergers and acquisitions going on in that space now than there has been in years. And we're seeing some of that in technology as well. So it's an interesting environment for this. But again, we're not necessarily in favor of, for most of our clients, illiquid investments through private markets. We think are something to be cautious about, especially when they talk about rolling them into options on people's 401k plans. So we do a lot of advising on 401ks, and we do not recommend that be added to a plan at this point. The other thing that's interesting on the alternatives, I guess, would be gold. People have been talking about gold. Gold prices have gone up. Silver
And
prices have
actually,
gone up.
Mike, we just had a question. What are your thoughts on precious metals in the investment mix?
Oh, well, whoever sent that in, thank you. Did Brian send that in? So it's interesting with gold and precious metals, silver. What we're seeing here is a chart that's trying to measure demand of gold. This is specifically about gold, and gold remains a consistent outperformer of stocks, at least in the last couple of years, and really since the bear market in 2022. But what started it all off was the Russian invasion in Ukraine. And around that time, we had the central banks starting to buy up gold. Okay, and that created more demand for gold than what we've seen in the past. Central banks, the Federal Reserve of other countries haven't been buying much gold. And so what you end up having is this big uptick in bank demand, central bank demand. They've got the money, they can buy up the gold. So that's driving more demand for it. And we're starting to see some of that subside. But gold has definitely been a beneficiary, gold prices, to these central banks ramping up their purchases. And they're slowing down a little bit, but they're not slowing down a lot. Gold also, is supported by quote unquote a safe haven investment, right? So conflicts in the Middle East, conflicts, in Venezuela, trade policy uncertainty, tariff talks, the passage even of, the big tax bill. These things create some uncertainty, and it renews kind of some fiscal deficit concerns. And if you're concerned about the fiscal deficit, you might be inclined to buy some gold. Okay. And so you've got this kind of almost perfect storm, high demand from central banks, a lot of uncertainty going on. So you get a lot of people buying precious metals, gold, silver. Here's the flip side of that conversation. It's all speculation for the most part. It's all supply and demand based on who's going to pay more for that gold next month than somebody paid this month.
Mhm.
There's no interest paid from gold or silver or any precious metals. There's no earnings. They don't make anything. Gold is just a metal. So there's a lot of speculation, and we think, especially at the prices that it's ramped up to, there's even more speculation in these precious metals, and so we're just not a big fan of them. Would we have liked to have owned them 2, 3 years ago? Yeah, but where they're at now, we think they're very, very high priced. Any thoughts, Brian or Michael, on this?
The other thing too, it's the dollar is getting weaker, so that makes gold prices look more expensive because gold is denominated around the world in US dollars. So when our dollar is weaker, which it has become weaker over the last several quarters, it makes the gold price go up or look more expensive. So
Mhm.
if our dollar gets stronger, that will take some of that froth off the gold prices. So
Yep.
that so
And the dollar has had a little weakness in it this past
mhm.
year. That's helped the international stocks, but we don't think the dollar's, done for by any stretch of
No,
the imagination. You know,
no.
so hopefully that answers the question that came in from one of our participants. If not, throw another question in there and we'll answer it for you. So with that in mind, we're coming to an end of our hour. We're going to take a little bit of time for people who are new to us or just want a review of how we work. We're going to go into that. But Michael, any other Q&As that have come up?
Yeah, I've got one. It came through as a more of a comment, but I'll ask it as a question. Can someone be a fly in the wall at your next party when you explain the bond market, Mike?
Maybe a fly in the wall, sure. I'm not exactly sure what that means, but yeah, we can definitely make sure that happens. Let me know, write down who sent that in, and we'll invite them to the next party.
Yeah.
Anything else?
Someone had made a comment regarding consumer spending, and a lot of consumer spending comes from the top 20% of income households, and a bump in that
Mhm.
segment could impact the strength of the economy. And it's just sort of a comment that makes me think of as well is with the big beautiful bill being passed, we're expecting higher tax refunds generally across the board here in the first quarter, and that could be a positive thing for consumer spending across the board as well. But any other thoughts as far as consumer spending goes from either you, Mike, or you, Brian?
Yeah, consumer spending can come, from staples, things that we need every day, and the consumer's discretionary, things that people could pass on. And that mentioned that the higher wage earners or higher net worth clients are still spending money both on discretionary and staples. Obviously, that's something that we've been watching, but the discretionary spending has been softened, again, over the last couple quarters, because the consumers are watching their dollars and their pennies, because everything else is so darn expensive on the staple side. So yeah, something to be watching on that, how it splits between discretionary and staples.
Yeah, that's a great point. The tax refunds are a great point
Mhm.
because what's interesting is these tax cuts that went into effect were retroactive to the beginning of the year. So to Michael's points, a lot of people didn't like change their withholdings or anything. They just and a lot of people are going to get much larger tax refunds. And what do we do when we get a tax refund as a country? We go out and we spend it, right? It's free money. It's just our own money coming back to us. But nevertheless, that's what tends to happen.
Mhm.
Um, so the point about 20% of kind of high income earners driving a lot of the economy, that is accurate, and it's that we're seeing a little bit of this divergence in the economy of that group of people that are driving a lot of the spending because they have the resources to do so, where other people are really struggling because their wages aren't going up or they're worried about losing their job, or inflation on the goods that they're buying have become a bigger and bigger part of their household income. So we don't lose sight of that. But when we look at the overall economy, it is driven by consumer spending, especially at the high end. And we think a big part of it's going to be driven by this CapEx spending around technology.
Another question came in. Any forecast for 2026 returns?
From the perspective, we think it's going to be real volatile. We'll probably, if I was going to guess, and then I'd really just come back down to earnings. Can we get $320 out of the S&P 500 this coming year, which is the high end of the consensus according to FactSet? If that would occur, we should have a pretty good market. We just have to keep a good eye on earnings. So last year, I think I was a little bit on the conservative side because I was concerned about valuations. This year, we have a lot of volatility coming. So if we come in at 7 to 10% on the S&P 500. I think that would be a wonderful year. Remember, during midterm elections, we come in usually around 4.8. So that's showing that there's some tailwinds that would help us have better returns this coming year. If our bonds also do anywhere from 5 to 7, you're getting a pretty nice rate of return overall in the portfolio, especially when you compare it to 3% or lower inflation rates. And remember, inflation is our biggest enemy, especially for a lot of our clients that are work optional. They're retired, and they have to worry mostly about inflation. So, anything else on the Q&A?
No other questions right now. Last chance if anyone wants to throw a question in as we're hitting the top of the hour here.
I'll tell you what, as they do that for our new people who are new to us, and again, as a refresher, I'll go through some of the disclosures that we have to show you. These disclosures say these are opinions. We don't know exactly what's going to happen in the future. That's why we talk about the lifeboat drill and staying, involved and engaged with your advisor. There's risk invested into markets. Yeah, I know this all seems things that are common sense, but we do need to cover these. Earnings go up and down. Fixed income investments go up and down. And so we want to make sure that we cover those disclosures. But for the new people, what I really wanted to cover is kind of how do we work? We spend a lot of time talking about the economy. We talked about investments. Really what's important here for us is that we're working with our clients on a long-term strategy to focus on what matters to them. We're building investments around what their goals are. And when I specifically look at the investments that the strategies we're focusing on, it's based on this acronym of FORM. So basically what we're doing is we're building plans that never lose sight of what's most important to you. Family is typically the number one priority for most of our clients. Occupation or work lifestyle is typically the other area that we're covering. Recreation, what do you do on your off hours? What do you do when you're in retirement? What's on your bucket list? Let's focus on those. And when we look at these three attributes to the planning, this is really why we do the plan. This is what drives life and what creates kind of a purposeful life. The M down at the bottom is our money, right? And money to us is like the gas in the engine. The other things are the engine that drives really what's important. The gas is needed, money is needed to give us options. The money needs to be invested appropriately. The money needs to be based at the right levels of risk to make you comfortable. But at the end of the day, the money isn't the end all be all. The family, the occupation, the recreation goals are really what drives purposeful life and enriched life. Okay. On the other side of this Venn diagram is what we can't control. We can't control what happens in this midterm election. We know that. We can't control what's going to happen in the Middle East and how that impacts investments and gold prices. But what we can absolutely control is what we call the 3 Ps. What's our philosophy? How do we stick with our investment strategy in ups and down time periods? And how do we stick with a strategy built around what's most important to you? Okay. And then we do that through our planning process. And then we do that by discovering what your needs are, designing a customized portfolio, and then deploying that that life wealth plan to meet those needs. Okay. And then that gets to our process. And what we call our process is the life wealth plan. And it sits squarely in this middle of what we can control and what matters most to you. So if we can get to that point, that's a pretty impactful environment for us to be in. So our FORM goals, again, are driving this. And then Michael and then Brian, we do these meetings on a regular basis with clients that come in, especially Michael and Brian, more so these days. Is there anything you'd like to talk about on these FORM goals or the impactful financial events that we're usually leading clients through?
I think I would just reiterate that philosophy of everything being interrelated to where if I have someone that is new to our firm coming to work with us, and they might ask in that first meeting, getting to know them, how should I invest my money? And the answer really is we need to take a step back and understand all of the priorities that we're working on and need to have in mind as we develop a plan for you. And so, I mean, we really believe in that overall understanding of your situation before we get to the specific recommendations. And I think that that is what has helped our clients be so successful because they know that their investment strategy is designed around the goals that they have.
Yeah.
You know, and over time, right? So if we're working with a 25 to 35-year-old, it's going to be much different than working with a 55, 60-year-old or 70-year-old. And I think that's also something we do very well at 360 is that we work with the younger generations. We have a sounding board process for our clients that have been with us for years. They can introduce us to their family, their children, their adult children, or their coworkers, and they can get that same experience, but the advice might be different because of their circumstances, age, or what their needs are, goals are.
Mm-hmm. Yep, absolutely. And in either case, when a potential client comes in to talk to us, that's what it is. It's a conversation. We figure it's about 60 minutes, and we spend at least 45 of those 60 minutes, 2/3 of the meeting asking questions. And the reason we're asking so many questions is, yes, we want to lead you through these impactful financial events, but we want to figure out and solve what are the issues that are top of mind to you, and how can we customize something that might really benefit you and your family. So as we're doing that, whether it's for you directly or for your other family members, we usually look at a cadence of focusing on wealth management pillars that are around tax planning, investment management, retirement planning, estate planning. These are all the pillars of wealth management. And risk, of course, is kind of a main pillar to lots of issues around all of these, and risk being insurance, and how does it help us manage the risk of our investment strategies and our life wealth plan. So it's a very involved, engaged process. So we have a very involved life wealth planning process. We have a very involved investment process, and kind of when we pull all of that together, what we end up with something that's customized for each client that comes in. And I think with that, we've covered at least a good part of how the process works. And if there's people on the call who are curious about learning more about it, then let's just schedule a conversation about what's important to you and see if the things that we do will help you be successful. We call that our fit meeting. Our services are a good alignment to your needs or a good fit to your needs, then we can determine what happens after that. So as we wrap her up, Michael and Brian and Cameron, who has been behind the scenes managing this webinar for us, is there anything that maybe we have not yet addressed, or last second question that might have come in on the webinar?
No, I don't see any other questions come in, but just as a reminder to everyone, this is recorded. If you found it helpful, and if there's someone else that you know of who would benefit from this information, feel free to forward that to them. It'll be available for replay. And thank you so much for joining us on this outlook for 2026.
Thank you. It's great
Thank you.
having everybody. We'll see you later.
Take care.